0.35%.
All right, so that's what's coming through in terms of calls and views across asset classes. Mark Matthews of Bank, Julius Baer and Company is joining us now to take some questions. Mark, great to have you with us here. Thank you very much. You know, Lawrence Belanco, chartist at CLSA, is saying fresh breakouts on the Nifty are here. And small caps, broader markets here should do very well as well. What are your thoughts, Mark? The new thing, there are two new things, I guess, as we start this week. There is all these protests in China, and then we, I guess, wait for Fed Chair to speak on Wednesday. Go on.
Well, with the Nifty, it is an emerging market, and to my mind, the consensus is still negative on emerging markets, which you can kind of understand because China's the biggest one, and we're all seeing what's happening there. But a lot of people know there are many other emerging markets apart from China. Anyway, my hunch is that he's right, and they could have a good year next year if it's true the dollar has peaked, which I think it is, and the U.S. doesn't experience a very deep recession, which I don't think it will. The most interesting index, in my opinion, actually is the Dow Jones Industrial Index, because as of Friday, it was up 19.7% from its low, which was on the 30th of September. So it's just a smidgen below actually being technically a bull market again. You wouldn't think so, but that's what it is. With China, what I would say is that short term it looks very bad, of course, but medium term it could be good if they finally let go. And that's something that nobody knows the answer to, but I would say that as opposed to back in April, which was the last COVID surge, when only 100 cities were seeing COVID cases, today it's over 300 cities that are seeing COVID cases. I don't see how they can stop it. So if they come to that same conclusion and they let it go, I think the market would react positively to that.
Mark, morning. What about Fed Chair Jerome Powell's speech on Wednesday? What's the expectation it will be amongst his last before the blackout period ahead of the December FOMC meeting? Should we expect a change in, to align itself with the market expectation that going ahead we are going to see lower interest rates? Can we expect some change in guidance?
Well, if we put ourselves in his shoes, I think we can understand the policy that the Fed has chosen, which is to try to walk down the middle. Because on the one hand, inflation is still very high, as you know, 7.7% in the United States. But on the other hand, there are signs of dysfunction in financial markets, and there are signs that we could get a recession in the United States next year. In fact, the Philadelphia Fed does a quarterly survey of 38 economists. It's been running that series since the 1960s, and last week they came out with the fourth quarter numbers, and 43% of I should say the average of them saw a 43% chance of a recession over the next year, which is the highest on record. So that's why I think they're doing what they're doing, which is they can't declare victory on inflation because it is still very high, but they have to do something to show that they acknowledge the dysfunction in financial markets and the possibility of a recession next year. So they're saying, well, we'll raise rates, but at a slower pace than before. And I suspect that is the message he will reiterate in his speech this week.
All right. Hi, Mark. Good morning. Mark, just when people are thinking that India is getting expensive, China seems to be getting themselves into a bit of a mess yet again. And that entire shift of India to China, that seems to have taken a pause, at least for now, going by what data points we have. Do you think that India still will be the beneficiary, or do you believe that at some point of time that China valuation will make it more attractive?
Well, Nigel, I'll point out one interesting thing that an analyst put out on the internet over the weekend, I should say. I just saw it over the weekend, and that is the relative strength index of the Hang Seng Index. So the Hang Seng Index is Hong Kong stock market. And if you look at the 14-month relative strength index, so that's a momentum oscillator, it's giving you a signal of directional change. It dropped below 30, which is a signal of being very oversold, and then bounced back above 30 It only did that once before, which, believe it or not, was 1967. That was a summer of great turbulence in Hong Kong. They had a lot of riots there back then. But anyway, it was the beginning of a very strong bull market after that. And you could look at the S&P and you'll also see that in its history, whenever you had that drop below the 30 level in the 14-month RSI and then it suddenly popped back, tended to be a signal that you were entering into a strong bull market. So there's no reason to think that there should be a bull market in Hong Kong now, and yet somehow the market is signaling one. I can only think that if it's true, they basically just let go and walk through that same valley that every other country has had to walk through, which means, unfortunately, that a lot of old people will die. But the economy will normalize and people will go back to regular lives, like has happened in every other country except China. Then I think the market would respond very strongly to that. Nobody knows. We just have to wait and see.
And Mark, I'm assuming it's natural that authorities in China would also be nervously watching what's happening in many other parts of the world, right? With these protests and whatnot, which is happening. So will they be forced to ease? That's something to watch out for. As of now, Mark, are you saying? I mean, the last time you were on, you were saying that you think into 2023, with all of the gains, relative outperformance in India, maybe the market here takes a bit of a backseat, and within emerging markets, China does much better. Is that the base case, in your opinion?
Well, I didn't foresee these protests, so now I'm not quite sure. But I did notice when I was watching those protests on television that the majority of the people on the street are young people, which you would expect. 1 in 5 young people living in the cities in China is unemployed. And every year, over 10 million more young people join their ranks, graduating from university, looking for a job. I don't see how they can really avoid the economy getting much worse if they continue to have these protocols in place. And it's already at a somewhat precarious situation. So if I had to guess, I think they're going to let go. And that would result in a very strong stock market. But it's hard to say, trying to analyze the politics there is very difficult.
Mark, pleasure speaking with you. Thank you very much for joining in. Get into a break. On the other side, our list of top 10 stocks is lined up next.